Right, class, we are covering our last and final section, which is the concept in CVP analysis. CVP analysis stands for cost, volume, profit analysis. And a critical concept before delving deep into CVP analysis is marginal analysis. And marginal analysis is defined as the evaluation of benefits that arise from producing an additional unit of an activity. So the additional benefits are compared with the additional cost of undertaking that production, right? So let's look at these concepts in CVP analysis. We have the marginal cost, marginal income, marginal cost ratio, marginal income ratio, and net income slash profit ratio. Let's just step back a bit and look at the break-even analysis. Um, Break-even is the concept that describes a situation where neither a profit nor a loss is generated. In other words, total revenue equal the total cost. The break-even point is a very important benchmark as it indicates how many units of a product need to be sold before you will start making profit. So indeed, this can be expressed in the number of units as well as in rand value. Let's then go back to the marginal cost because marginal cost is the cost of producing an additional unit. And this marginal cost is a variable cost, right? And as a variable cost, it includes many other expenses such as selling, overhead, and administrative expenses. In order to make it simple, let's look at an example. And we have an example here of a shoemaking. This shoemaking business makes 700 pairs of shoes every month. But in order to provide a wide variety to its customers, they increased the number of shoes to 800. And the variable cost, including the selling cost to make one pair of shoes, is 50 rand. So the total variable cost to make 700 shoes is 50 rand multiplied by 700 gives us 35,000. And while the variable cost to make 800 shoes is going to be 40,000. And a formula is provided to you. So the marginal cost will be the change in cost production divided by the change in quantity produced. So the change in cost production is 5,000. The change in quantity produced from 700 to 800 is only 100. So 5,000 divided by 100 gives you 50 rand per shoe, which is the marginal cost. And as you can see from the example, the marginal cost is equal to the variable cost. Now let's look at marginal income. The marginal income is also known as the marginal contribution or the contribution margin. It is that difference between sales and variable cost. It is all about that margin, right? That margin which is the profit, right? So the marginal income is used to analyze how the behavior of a business variable cost affects its. And why is that? Because that marginal income, right, is used to cover the fixed cost. All variable costs are set off against sales, and that accounts for all items that vary in proportion to volume. And this is usually done on a per unit basis. So remember again, margin, that's tiny margin. So both the marginal cost and the marginal income can be expressed as a fraction or percentage of sales, either um, on a unit basis where the marginal cost per unit is expressed as a fraction or a percentage of the selling price per unit. Or you can use the total marginal cost and you express it as a fraction or percentage of the total sales revenue. And here the formulas are provided to you. So you have marginal cost ratio, you take the marginal cost, you divide by sales, and you multiply by 100. And this is a practical way to look at it. Let's say we're looking at a marginal cost ratio of 60%, right? Or zero point 0.6. It means that 60 cents in the rand are variable costs. 60 cents in a rand revenue, right? In a rand of sales revenue is variable cost. And same logic applies to marginal income. When you're looking at a marginal income of a marginal income ratio of 30%, it means that 30 cents in the rand of sales revenue comprise the marginal income, right? And obviously, you all know the net income ratio. Net income ratio, you're looking at the net profit. And for this one, it's very important to take the total rand value. So it cannot be done at a unit basis. You have to look at the total rand value or the total net profit divided by sales multiplied by 100. Why you can't do it at the unit sales? It is because the fixed cost will distort the result. And finally, two formulas that will help us now calculate the break-even point. So when we're talking about the break-even point in terms of units, we take the total fixed cost divided by the marginal income per unit. And when we're looking at the break-even point in terms of sales revenue, we will take the total fixed cost divided by the marginal income ratio. If this sounds confusing, worry not, because there are plenty of examples to help you understand all this. So you have example 4.3 with the various components or costs that need to be classified as either fixed or variables. So you have this table that is provided to you. You have the wood, you have direct labor, factory supervisors, wage. As you can see, you need to be able to classify which one is fixed cost uh, per month and variable cost per month. In any case, this is already done for you. All right. The beauty of this is that this links to the previous example in 4.1 that we were doing. So there is continuity in these examples, which is quite relevant. And if you remember again, we have the total cost that was 342,000, right? So just like in example 4.1, same items in example 4.1 are provided here in this table. It is that famous example of the JSS, right? And here we're going to use the CVP analysis in order for us to find the break even, right? Or make the break even analysis easier. And we know that the company intend on producing 200 units a month, right? And we know the total, right? The total costs. So what we do is we take the total cost divided by 200 and we find that 1,613 per JSS manufactured, and that is the marginal cost per unit. It is the variable marginal cost per unit. And this variable cost is the first step in your CVP analysis. So the first thing that you need to determine in your CVP analysis is what is the variable cost per unit produced. And it is important here to understand that the break-even point is a very important figure in which strategic decisions can be based. It is the starting point in many pricing decisions that are made. So what this company would have done here is to try to find the selling price for the JSS that would maximize the profit of the company. It is an economic decision and it is for entrepreneurs who understand the basic principles of supply and demand, such as if the price is low, consumers will demand more of the product, and if the price is high, they will demand less. These are economic principles. So a decision has to be made on the price. That's what we understand. That will maximize the profit. And in this particular example, we are told that 3,000 Rand will be the price, and it is the same price actually that the company is buying from the wholesaler, right? So they are charging the same price, and the reason for that is that they would like to attract more customers, right? Now that we have the price, what can we now get out of this price? Once we have now the selling price, we can use the selling price to find the marginal income, right? We will take the selling price of 3,000 minusing the variable cost or the marginal cost, and that would give us the marginal income. So as you can see, we determine the marginal cost in the first step. In the second step, we determine what is the marginal income, and finally, we can be able now to find the break-even points that can be now calculated. And if you look at our table, right, our table, come back to the table, it's very important. We can see what the fixed cost for the month is. It's 20,000. This table is not there for nothing. It is very, very important again, and I'm drawing your attention to this. The reason why we were looking at the categorization between fixed cost and variable cost is so that we can have the total fixed cost and the total variable cost. Both of them gave us the total cost of everything, right? Total cost of everything was 342,000, and the fixed cost in it was 20,000, right? So these can now help us to find the break-even points, right? So the break-even point in units. So we would take the total fixed cost divided by the marginal income per unit. That will provide us exactly the number of units that need to be sold for the company to break even. And for the break even point, in value, in rand value, we will take the total fixed cost of 20,000 divided by the marginal income ratio. And how do we get the marginal income ratio? We take the marginal income divided by the divided by the selling price, and that's what gives us the marginal income ratio, right? So we take this will help us to get the rand value. As you can see there, the two formulas are applied. You get not only the rand value, but you also get the number of unit that needs to be sold in order for the company to break even. And I remind you again, what is again the break even? It is that point where the total cost equals the total revenue. And I play with the formulas for your benefit for you to see what this means. For example, the total revenue, you take the total unit, pardon, I mean for the total cost, you take the total unit, multiply by the sum of variable cost and fixed cost per unit, right? If still confusing, there are other examples that you can use. The solutions to these questions are in your solution sections of your textbook. Please practice